निरंकुश हो पाएगा क्या? Right. Welcome to today's session on tax planning and investment. Uh, this session of today's has been brought to you by Fee Money. Before we start our session, let's talk a little bit about Fee Money. Fee Money was founded in 2019, and it is the brainchild of ex-Googlers who pioneered GPay, Sujit Narayanan and Sumit Galwani. They have their team of expert, and they are from Google, Netflix, PayPal, and other, and they come together, distill decades of tech and banking wisdom into a money management app, which is created for working professional. It is a integrated financial service platform, and its users gain access to a new saving account and investment platform and money management tool with features that help user to know their money, grow their money, and organize their fund. So this is a one window which caters all the financial need of the user. The fee app therefore takes on a one of a kind approach, rewarding user for saving money and not just spending. Uh, so it's a wonderful way to manage and organize their money, grow their money by a new age professionals who are much more acquainted with technology, and they are willing to grow their money in a few clicks of a button. Right. And they have a wonderful salary account, which is targeted towards working professionals with a suite of features that is designed for salaried millennials. And when they thought of making a salary account product, they wanted to solve the experience. The Right now, fee money is giving you a very wonderful experience in related to operating a salary account. So it's a wonderful app, and we are so delighted to be partnered with them. Now, uh, in today's webinar, we are going to talk about the tax planning and investment. And if you have any question, there is Rahul in the chat box who will be answering all those questions. And at the end of the session, I will be taking the questions from the chat box if you have any. And let me introduce myself. My name is C. Kotroy, and I have been working with Clear for last 4.5 years. Rahul is also with me for the same amount of time. He is a working professional, and he is a CS, and he is helping the team of tax professionals here in Clear Tax. Now, in today's session, we are going to understand who should plan for their investment and why should be one be investing. What are the various investment opportunities available, and when do we declare such investment to your employer? And we are going to take a look at certain uh, aspects if you are not submitting the proof, or uh, something has prevented you from submitting the proof. And we are going to talk about something that is required to be kept in mind during the year. Now, uh, let's try to understand who should be planning for investment and its declaration. Now, presently in India, there are two tax regimes prevalent. One is the new tax regime, one is the old tax regime. Due to the recent budget, the new tax regime is much more prevalent and it's the talk of the town. And going forward, yes, most definitely it will be the talk of town, but still the old regime is there, it cannot be ignored completely. Why? Because there are certain aspects of the old tax regime that is still relevant. Therefore, who are uh, earning, or rather who are earning income more than 5 lakh rupees, and they are declaring their income under the old tax regime, most definitely they should be planning for investment and its declaration. Now, what are the investment or expenses that can be declared? The insurance, the home loan, rent paid, received, uh, your life insurance policy, national pension scheme, pension policy, or home loan, etc., etc. They should be declared. Now, all these items they have a positive impact on tax saving when declared under the old tax regime, and how they act together we are going to understand in the later part of this webinar. Also, uh, when you are declaring the tax saving deductions and expenditure, it must also be noted that you should also be declaring certain incomes that forms part of your tax return. For example, FD interest, for example, savings bank account interest. Now, usually all these incomes are taxable after a certain limit, right? So if we are talking about savings bank account interest, it is taxable beyond 10,000 rupees. However, FD interest, that is always taxable at its full extent. Now, excuse me, why I'm asking you, or rather giving you advice to declare all this income to your employer, because if you are including all this income at the time of filing your income tax return, and since all these incomes are tax payable income, or other tax need to be paid on such incomes, you could end up paying a huge amount of interest, because at the end of the day you will be paying the taxes, so there is no question about it. But if you are defaulting in paying the taxes in on advance basis, then the income tax department can levy, or they are levying a huge amount of interest on you. Therefore, it is pertinent, or rather it is very much prudent action on your part to declare all this income to your employer, so that they compute all this income together and compute the taxes and deduct the taxes accordingly, so that you can avoid paying a good amount of interest at the time of filing the income tax return. Now, uh, as of now, understanding the declaration process, or declaration of incomes or expenditure, now one question might arise, that why should one be investing? Now, first and foremost, the major reason to invest is to save the taxes. Now, in the present year's budget, uh, the lot many things has been allotted to make the new tax regime much more attractive, right? But under the old tax regime, the tax regime it is competing, the new tax regime is competing, they gave us a huge amount of tax saving, and all the tax saving instruments are designed in that particular fashion, that you are going to save the taxes if you are investing in XYZ instrument. So, yes, uh, saving the taxes is one of the key idea why one should be investing. Secondly, financial planning and saving for the future. Now, just because you want to save money, and by not paying the taxes you want to park money into tax saving instrument, that should not be your ideal goal. You should be investing because you want to have a secured future. So after certain time, after maybe 50 55, there are a lot many people who are taking early retirement, and going by the inflation and everything, it's a very good idea to have a good amount of corpus at the time of one's retirement. Therefore, if you want to retire early, if you want to enjoy life, then most definitely you should be starting early and you should be starting to invest. Therefore, uh, keeping financial planning in mind, you should be investing absolutely. And also, if you are investing inadvertently, you are creating a wealth, you are creating an asset, right? You may be investing in some sort of instrument. It may be shares or stocks, it may be a house, whatever it may be. But inadvertently you are creating a wealth, you are creating an asset for yourself, which can generate a good amount of cash inflow in future. And finally, reducing unwanted expenditure. If you want to if you are not left with much money in your hand, most definitely you will not be able to spend. Therefore, whenever the salary gets credited, you should be going ahead and making those investment decisions so that you can avoid unwanted expenditure. Now, having understood the need of investment, let's try to understand tax saving on certain expenses. Now, if we look into our day-to-day expenses list, there are a couple of expenses which can have a tax saving impact. The most important and well known of them all is the house rent allowance. Now, the basic idea of house rent allowance is if you are staying in a rented apartment, right, and you are working and your employer is giving you a allowance to meet the house rent, in that case, you are uh, the amount of rent that you are actually paying, that can help you to save the taxes. Now, the way it works is a certain amount is deducted from your salary at the very beginning, and you are left with a net amount. On that net amount, all the other deductions are worked out, and the tax payable and tax deduction happens. However, there are a couple of notions which are not correct is in the minds of the people. Firstly, uh, I can deduct HRA whether my if we pay the rent. There is no other criteria. This is actually not a correct notion, because if your salary does not have a HRA component, house rent allowance component, you cannot deduct the HRA from your salary. Second thing, uh, people are also thinking that the amount of rent that I am paying, then in its entirety, the amount is deducted as house rent allowance. Again, this is not the case. There are certain calculation that happens before computing the deductible HRA. For example, if my salary is structured in a way, basics, HRA, and all the other allowances, I will be able to take only a specific amount from my salaried income, right? The amount is lesser of these three, 40% or 50% of the basic actual amount of HRA that I am receiving, and actual rent paid minus 10% of the basic. We are going to put those theory into numbers at later point of time in this presentation. Secondly, leave travel allowance. Now, this leave travel allowance has been with us for a quite a long period of time, but recently it is gaining people's focus, because at the time of COVID, when people were not able to travel, our finance minister decreed that leave travel allowance will be substituted by cash voucher, and from there onwards people came to know about leave travel allowance, and they are taking advantage of leave travel allowance since. Now, the basic idea behind leave travel allowance is uh, to reduce the traveling expenses from your taxable income, right? So it is given to you twice in a block of 4 calendar years, right? The recent calendar year block has started from 1st January 2022. Now, to get this leave travel allowance, there are again certain criteria. Firstly, your salary should have a LTA component. If LTA component is not there, you cannot take advantage of leave travel allowance. Secondly, You can travel with your dependent spouse or children. However, the one of the most rigid condition placed upon it is that only to and fro expenses are allowed. That too, if you are traveling via first class train or AC 2 tire or AC 3 tire, or in case if you are traveling by air, economy flight ticket. If you are thinking about claiming the meal expenses, the taxi expenses, all those things, they or lounge expenses, all those items cannot be deducted. Only to and fro expenses from the place of your origin and the place of your destination via air, or in case if you are traveling by train, first class, AC 2 tire or AC 3 tire tickets. There are certain other expenses as well which can be taken as deduction. For example, petrol expenses for motor car. So many of us after COVID time started using our own cars to travel to office, right? And for that, we are spending quite a lot of money in petrol, right? So if your salary structure has flexible component in it, then you can certainly allocate certain amount of money into petrol expenses or traveling expenses, and you can save the money while putting petrol in your motor car. Now, there is a certain computation which gets involved in computing the actual amount of expenses that can be deducted. But if your salary structure does have this option, then you should be absolutely going for it. Furthermore, food coupon allowance is there. Again, it comes from the flexi benefit thing in your salary. And 50 rupees per meal for maximum two meals for 22 working days are allowed. In short, maximum amount that can be taken per month is 2,200 rupees. Right now, this food coupon allowance, you can use it to order food, you can use it to get groceries. So it's a small little thing, but it can save a good amount of taxes. Furthermore, uniform allowance is also there. If your employer approves uniform allowance, then whatever the clothing you are wearing to office, that expenses can be deducted. Now, coming down to other expenses, again, apart from all these allowances that forms part of the salary, another tax saving expenses that is in vogue today, that is interest on home loan. Now, interest on home loan can be taken as deduction under two sections, right? One of the most popular section is section 24B, under which the amount of interest that you are paying on the home loan is deductible. However, to claim this amount, there are certain conditions that need to be mentioned. Firstly, uh, the home loan, the interest paid on home loan benefit that can be availed from the year of occupancy in that house, right? In short, if the house is still under the construction, in that case, you cannot claim the interest payment benefit. Secondly, the house should be a self occupied property, right? And in case the house is a self occupied property, then maximum amount of 2 lakh rupees of deduction can be claimed. Now, let's come to certain burning issues in respect of this section 24B. Firstly, excuse me, in the original discussion that I have mentioned that the interest can be claimed once the house is completed or you have the possession of that house, right? So what happens when I have taken the loan but and paying the interest, but still the house was under construction? In that case, you have the option to accumulate all the interest that you have paid and claim that amount in five equal installment from the year of possession. For example, the house you have purchased in 2020 and in 2022 the house gets completed, right? In these 2 years you have paid a interest of 2 lakh rupees, right? In 2022 end you started living in that house, right? You got the possession and you started living in the house, and in that year you have paid an interest of 1 lakh 50,000 rupees, right? So I will most definitely be claiming 1,50,000 rupees for the year of possession. And along with that, I will be taking one fifth of accumulated interest that was there for the under construction period, right? The total under construction interest is coming to 2 lakh rupees. One fifth of that is coming to 40,000 rupees. So in the year of possession, I will be claiming 1,50,000 rupees plus 40,000 rupees, in total 1,90,000 rupees. Second point is, again, many people have this question in their mind, specifically the persons who are staying in a different city from their hometown for employment purposes. Most of the people have purchased a flat wherein their parents are staying, and that flat is in their hometown, and they are staying in a different city altogether for their employment purposes, and they have taken a place on rent and they are claiming HRA. Now the question people raise is, I have a home loan, I have HRA also. Now, can I claim both of them simultaneously? To which the question is yes, you can go ahead and claim, because the house property for which you have taken the loan is in a different city, and it is being occupied by your parents, which is as good as self occupied house property. You are staying in a different city for your employment purpose, and your employer is giving you a allowance to meet the rental expenditure. Then yes, you can claim HRA as well. Therefore, there is no clash between these two sections in this respect. Therefore, you can go ahead and claim HRA and home loan interest benefit. Second most common question is, in case the loan is taken in the joint capacity, right? So one person is borrowing the money along with their spouse. Now the question that arises is, I have a house property which is under both the spouse's name. I have a home loan that is also both under the spouse's name, both spouses' name. Now, what will be happening to the interest component? Since house property, the flat itself and the loan, they are under the name of both the spouses, they will be able to take the benefit of that amount in equal terms. So, for example, if the interest component of the house is 2 lakh, or rather 5 lakh rupees, then each of the spouses can take 2.5 lakh rupees in their tax return. However, it is to be remembered, maximum amount that can be taken is 2 lakh rupees. So, both the spouses can take 2 lakh rupees and 2 lakh rupees in their income tax return as deduction for interest on home loan paid. Along with section 24B, another section works in tandem with in respect of interest on home loan. That is section 80 EEA. Now, under section 80 EEA, if gives you an additional deduction of 1.5 lakh rupees, which is over and above 2 lakh rupees of limit under section 24B. However, there are certain stringent conditions that needs to be fulfilled. Firstly, the loan should be coming from a banking institute. Secondly, the loan must be sanctioned between 1/4/2019 till 31st of March 2022. Also, the stamp duty value of the property should not be more than 45 lakh rupees. And finally, the loan should be taken to purchase the first property of the person. Now, the second question, or rather the last point, gives a good amount of questions, right? It raises a good amount of question. The question being, I have inherited a house property, right? So the house property is also registered under my name, but I have not taken, or rather I have not purchased any house property. It was inherited. Now, can I be able to claim section 80 EEA benefit? To that, answer is no. At the time of taking the benefit, there should not be any house property registered under your name. If any house property is registered under your name, then section 80 EA benefit will not be made applicable for you. Now, Those were the most talked about tax saving expenses. Now, let's take a look at the investment option under ATC. Firstly, we are going to talk about PF. Now, PF can be of many kind: EPF, PPF, or VPF. Now, EPF, every month your employer deducts from your salary. PPF and VPF, in these two funds you contribute on your own. The PPF enjoys a EEE status, that is exempt status. That means at the time of investment it is exempted. Any amount you are earning as interest is exempted, and any amount you are receiving at the time of its maturity is also exempted. However, in PPF you can invest maximum 1.5 lakh rupees in a year. VPF is a recognized provident fund wherein you can invest any amount of money as you wish. Now, all these items can be claimed under Section 80C. Also, children's education fee or tuition fees. Now, tuition fee paid to for education of the children is deductible under 80C. However, there are certain expenses that can be claimed under tuition fee. Firstly, the actual admission and the actual education fee is deductible. However, any amount of developmental fees or donations are not allowed to be deducted. Life insurance premium. Now, any policy taken from any insurer to keep a life insurance policy in force, that premium is deductible from income, which falls under Section 80C. Principal on home loan. Now, we have talked at length about interest on housing loan. Now, let's talk about principal on housing loan. The principal on housing loan can be taken as deduction under 80C. However, to claim this amount, again, the construction of the house must be completed and you should be having a occupancy certificate. Uh, ELSS. Now, ELSS is a fairly new tax saving instrument. Uh, the benefit of ELSS is it has a very short lock-in period as compared to other tax saving instruments. For example, tax saving FD has a lock-in year of 5 years. PPF has a lock-in period of 15 years. As compared to that, ELSS has only 3 years of lock-in period, right? Now, if you are investing in ELSS, you have a benefit of investing in equity-oriented mutual fund as well, right? So, in case you are gaining some amount after 3 years, obviously you will be able to sell off ELSS fund or redeem the ELSS fund only after the expiry of 3 years. In case you are doing that, any gains that you will make above 1 lakh rupees will be taxable. Any gains you are making below 1 lakh rupees or not exceeding 1 lakh rupees, that is not taxable. Now, even if the gain is taxable, that is taxable at a lesser rate of 10%. Therefore, ELSS has a dual benefit of saving the taxes and building the wealth as well. Tax saver FD, if you want to take a safer route, then tax saver FD might be the tax saving instrument for you. However, excuse me, the lock-in period for tax saver FD is quite long as compared to ELSS. It is 5 years, and whatever interest that you are earning on tax saver FD is always taxable. Further, there are other instruments that you can explore for save the taxes. For example, SSY, Sukanya Samriddhi Yojana. Now, if you are blessed with a girl child, then you can start investing in her name in this particular scheme, and you can invest in this scheme till she attains majority. Now, after she attains majority, you will be left with a good amount in corpus, which you can spend for her higher education. Now, there are other old school and quite conventional tax saving instrument. Those are national saving certificate and post office deposit schemes. Now, we are going to talk about other options which has a benefit at the time of your retirement. For example, pension plan. Now, any amount you are contributing towards pension plan is deductible under ATC. Also, contribution towards NPS, National Pension Scheme, can have a good tax saving effect on you. Now, in NPS, you can invest in three ways, or rather, two ways. One, you can invest on your own, or two, you can invest in NPS through your employer. Now, in your own contribution, that can be counted twice in two different ways. Number one, by default, any contribution you are making towards NPS goes towards the limit of 1,50,000 rupees under ATC. However, if you are contributing much more, then eh, you can take benefit for investing in NPS maximum up to 50,000 rupees additionally, right? So, if your ATC limit is already filled up, right? Maybe you have PF of 20,000 rupees, you have SSY of 1 lakh rupees, ELSS of another 50,000 rupees. All in all, your ATC limit is completely filled up. In that case, if you are investing in NPS, then you can take deduction of additional 50,000 rupees. Now, this is how the NPS works. However, there is another way you can invest in NPS, that is through your employer. Now, if you are investing in NPS through your employer, then maximum 10% of the salary, the basic salary, can be contributed and the benefit can be availed. However, one thing you should be keeping in mind, that maximum amount tax-free contribution in NPS or VPF can be, or any annuity scheme provided by employer, that can be maximum of 7.5 lakh rupees. If contribution in NPS through your employer or any annuity scheme, which is more than 7.5 lakh rupees in a single year, then such excess contribution becomes taxable. Now, having understood the tax saving opportunities and deductions, let's try to understand whether the new tax regime is the way for me. Presently, the new tax regime does not look that attractive in front of the old tax regime. The old tax regime is beneficial in multiple ways of giving you the deduction. Firstly, it gives you the benefit of taking HRA, the home loan, the standard deduction, everything. Under the new tax regime, none of these are available. However, in the recent budget, it has been proposed that under the new tax regime, you will be able to claim standard deduction of 50,000 rupees, right? And the slab rates are also being enhanced. Tax rate has also been revamped, which actually brings the new tax regime in a competitive area in respect of old tax regime. However, in this slide, so we are going to talk about the old new tax regime. The old new tax regime was pale in comparison to the old tax regime. Now, how it was pale, let's try to understand with an example. Firstly, we're going to see a salary structure of 10 lakh rupees, right? So the basic salary becomes, in this case, is 50,000 rupees. HRA allowance, house rent allowance itself becomes 2 lakh rupees, and any other allowance becomes 3 lakh rupees, all in all 10 lakh rupees, right? That person is staying in rent in Bangalore, right? For which 20,000 rupees per month he is paying. Now, let's come to tax computation. Under the new tax regime, none of the deductions are available. Therefore, the total salary is 10 lakh rupees. However, the old tax regime, I'll be able to reduce HRA, which will be coming to 1,90,000 rupees. Now, let's try to understand how HRA actually works. Since Bangalore is not a metro city for the purpose of computing HRA, in that case, 40% of basic will be my first figure, which will be coming to 2 lakh rupees. Secondly, the actual amount of HRA, that forms part of my salary is also 2 lakh rupees. And finally, rent that I am paying minus 10% of the basic will be coming to 1 lakh 90,000 rupees. Out of these three figures, 2 lakh rupees, 2 lakh rupees, and 1 lakh 90,000 rupees, because it is the least amount, 1 lakh 90,000 rupees will be taken as HRA deduction. We also will be reducing 50,000 rupees of standard deduction and 2,400 rupees of professional taxes, which will give me a total net salary of 7,57,600 rupees, as opposed to 10 lakh rupees of salary under the old new tax regime. Along with all these expenses, I also have made some investment in ALS, LIC, ELS, SSSY, EPF, etc. etc. Under the old tax regime, I will be able to reduce everything. Under the new tax regime, I will not be able to reduce anything. After taking deduction of 80C and 80D, I will be left with salary of 6 lakh 19,000 rupees. Under the old tax regime, under the new tax regime, 10 lakh rupees, there is no change whatsoever. Now, let's come to tax computation, because up to 2 lakh 50,000 rupees under both the regimes, there is no tax rate. From 2 lakh 50 to 5 lakh rupees, the rate of tax is 5% in both the regimes, which will give me 12,500 rupees of taxes under both the regimes. Now, the old regime diverges, because from 5 lakh to 7 lakh 50,000 rupees, the rate of tax is 10%, which will give us a tax of 25,000 rupees, and 7 lakh 50 to 10 lakh rupees, the rate of tax is 15%, which will give me a tax of 37,500 rupees. Now, if we are coming to old tax regime, beyond 5 lakh rupees, the rate of tax is 20%. However, beyond 5 lakh rupees, my income is only 1 lakh 19,000 rupees. Now, on that 1 lakh 19,000 rupees, the rate of tax is 20%, which will give me a tax of 23,800 rupees. All in all, under the new tax regime, my income tax will be 75,000 rupees, and we are going to increase it with health and education cess of 4%, which will give me a tax payable of 78,000 rupees. Now, under the old tax regime, it is 36,300 rupees of tax payable. 4% of health and education cess will give me an amount of 1,452. So total tax payable will be 37,752, which will lead to a tax saving of 40,250 rupees under the old tax regime. Now, you can save another 15,600 rupees if you are investing in an NPS. So, again, we are going to walk through it real quick, because if you are investing in NPS, you will be able to get another 50,000 rupees over and above 1,50,000 rupees limit under 80C. And if you are falling under the maximum marginal rate, that is 30%, in that case you can have a tax saving of 15,600 rupees. Furthermore, there are other ways you can save the taxes. For example, section 80D. Now, section 80D is specific for health insurance premium. If you are not a senior citizen and your parents are not senior citizen, in that case maximum 25,000 rupees you can take for both. That is for you, your spouse, and your children, 25,000 rupees, and your dependent parents who are not senior citizen, another 25,000 rupees. In total, 50,000 rupees. Now, if you are senior citizen and your dependent parents are also senior citizen, in that case 50,000 rupees for yourself and another 50,000 for your dependent parents. Now, let's come to a situation wherein you are not senior citizen but your parent are senior citizen. In that case, maximum amount that can be claimed is 25,000 for you and 50,000 rupees for your dependent parent. Now, one question again arises, that one of the parent, for example, my father is a senior citizen but my mother is not. So what will be the limit for me, 25,000 rupees or 50,000 rupees? Now, the law is pretty clear in this case. Any one of the parent need to be a senior citizen to avail the higher deduction limit of 50,000 rupees. Now, if senior citizens are not covered under any of the medical insurance, in that case, in lieu of medical uh, insurance premium, medical expenses can be taken as deduction. However, it must be noted that they are not covered under any medical insurance. Sometimes organization, what they do is they take a group insurance policy which covers both the employer, employee, and their parents. In that case, since they are covered under any medical insurance, one medical insurance, medical expenditure cannot be availed. Other section under which the deductions can be claimed are section 80DD. That is, if a dependent of the employee is differently abled, in that case, certain amount can be deducted for their maintenance purposes, right? In case the disability limit is more than 40% but less than 80%, in that case, 75,000 rupees of maintenance expenses. In that case, or in other case, if the disability limit is more than 80%, in that case, 1,25,000 rupees can be taken as maintenance. In case you or your dependent are diagnosed with specified diseases, then 40,000 rupees or the medical expenditure, whichever is lesser, can be taken as deduction. If the person in question is a senior citizen, then in that case, limit gets extended to 1 lakh rupees. 80U same as 80DD. However, the difference is when the assessee himself, the person in question himself, is differently abled, then depending on the disability limit, 40% or 80%, the amount can be deducted. Then coming to 80E, that is interest on home education loan. Now, education loan, there is no bar on the amount which can be claimed. So any amount can be claimed on education loan interest. And finally, donations. If you are making charitable donation into a charitable or religious trust, then depending on the nature of the trust, 50% or 100% of the donation can be taken as deduction. For example, PM Cares has a status of 100% donation. So if you are investing or rather if you are donating in PM Cares fund, in that case, if you are donating 1,000 rupees, you will get a deduction of 1,000 rupees. However, if you are investing in any religious trust, in that case mostly 50% deduction is there. So if you are investing or if you are donating in a religious trust, 1,000 rupees maximum amount you can deduct is 500 rupees. Now we are at the end of the session wherein we have talked about the importance and what are the investment proofs that you need to be keeping in hand, right? Now we are going to talk about investment proof submission, right? So, and what happens if you are not submitting the proof? Now, mostly in the month of December and January, every employer opens up a declaration window or proof collection window, I would say, wherein every employee are requested to submit the investment proof that they have declared at the beginning of the year. In case they are not submitting, their declaration at the beginning of the year is completely ignored and tax computation is done afresh. And since all the investment proofs have been discarded, ignored, the tax computed is at a higher extent and tax deduction happens at a higher extent as well. Now, if this situation is applicable for you, you don't really have to worry because at this point of time, yes, you will be subjected to a higher tax deduction. However, at the time of filing your income tax return, all the documents, all the investments that you have made which are missed, it can be claimed, right? So it can be claimed at the time of filing your income tax return. Therefore, since you have paid additional amount of tax, the excess amount of tax, after declaring all the other incomes and everything, it can be given as refund to you by the income tax department. And finally, one key point I would like to raise is, if you are switching the job, right? So if you have switched the job during the year, then there is a possibility that your present employer have not considered earnings of previous employment. Also, they have not considered the tax deduction of the previous employment as well. Now, if this situation is there, you could face a serious situation at the time of filing the income tax return, because income tax return, you are supposed to show uh, income from all the employment in consolidation, right? Now what happens is, if your present employer is not considering the earlier employer's salary and tax deduction, they are going to compute the ATC deduction that is given to you all over again. They are going to compute the standard deduction, the basic exemption limit of 2 lakh 50,000 rupees. All these deductions and benefit are given to you all over again, and your tax computation goes for a toss. Therefore, if you are under the suspicion that your tax deduction is not happening at the level of the previous employment, you should raise the issue with your HR department or payroll department, whosoever is in charge. One red flag should be, since you have switched the job, there is a very good chance you have switched the job because of a salary hike. And if you are getting a salary hike, most definitely your tax deduction will also be increased, right? If it is not increased, it is, if it is remaining at the same level, or if it has been decreased, in that case you should definitely talk to your employer, the payroll team, once, to get these things sorted out. Now we are at the end of our session and we are going to take some questions. Right. So Kunal is asking, can I claim previous year's education expenses in this year's ITR form? Now, Kunal, I have never talked about education expenses. I have talked about interest on education loan. Now, education on interest loan happens year to year basis. So, if you are filing this year's income tax return, then this year's interest component needs to be declared, right? If you have not claimed the previous year's education expenses, I'm afraid the timeline is over, the window is over, and you cannot claim any deduction for that. Right. So tuition fee, if the tuition fee is paid for financial year 22-23, then most definitely you will be able to claim uh, for the income tax return filed, income tax return which will be filed for financial year 22-23. But if you are talking about claiming tuition fee that was paid in financial year 21-22 and claim the same in the income tax return for financial year 22-23, I'm afraid it is not possible. Right. Losses accrued in share market in financial year 22. If you have filed your income tax return for FY22, then most definitely you will be able to claim the losses. And the loss, for your information, can be carried forward for a period of 8 years, not 2 years, provided you are not talking about speculation income or intraday losses rather. Right. If you are talking about only short term or long term capital gains, then yes, most definitely it can be carried forward for 8 years, and any gain that is happening in those upcoming 8 years, carry forward losses can be set off. However, one thing you should be keeping in mind, that long term capital loss can only be adjusted with long term capital gains. Right. Uh, so Kunal, in that case, you can take benefit under Section 80 DDB. Yes, most definitely you can take deduction under Section 80 DDB, and the diagnosis report and everything that needs to be there. Also, the amount uh, that can be deducted, that will depend upon the age of your father, and I'm really very sorry to hear this. Well, 80D will be applicable for their medical expenses uh, in case he is a senior citizen. Sorry, in that case, 80D deduction cannot be claimed. However, 80DDB can be claimed. However, the maximum amount that can be deducted is 40,000 rupees. Right. So we are at the end of our session. Uh, Thanks for joining with us. And I would like to thank Fee Money for giving us this wonderful opportunity. Uh, I hope you had some great learning and you will be able to implement this in your life as well. Thanks for joining us. Have a great day. Bye bye.